What's been happening in the market? And more importantly, what does that mean for you? Welcome to LVZ Market Minutes, the quick and refined update designed for savvy investors who value clarity over clamor. Our team breaks down the trends, movers, and the headlines that matter so you can stay informed and cut through the noise. Let's dive in. Past performance does not determine future results. Securities offered through Harbor Investments, Inc., member FINRA SIPC. Investment advisory services offered through LVZ Inc. LVZ Inc. is a federally registered investment advisor. So February felt short and sweet, maybe. January felt long and a lot going on. February is a abbreviated month, and I feel like we all held on to the edge of our seats waiting to see what happened with a new administration. And I feel like we're still holding on to the sides of the chair because not really much has happened as far as impact in the overall scheme of things, even though things are coming down the pipeline related to tariffs. So, Joey, I'm glad we can sit down today to decipher what some of those anticipated moves may do to the market from a consumer perspective and how that impacts our client portfolios. So give me a little bit of a recap then. How did that trickle-down effect impact what happened in the markets in February?
Obviously, we talked last time around here about the valuations, the broadening of the market, how we were seeing high valuations, people reconsidering pricing of equities. And that definitely continued to play out in February. There was a lot of the front runners over the past 1-2 years, these big names that you had to have in your portfolio if you wanted to be competitive, they just tanked. And not entirely off of bad news. There was just a reconsideration. There was so much good news baked in. And there was sort of a reallocation of valuation. So that was playing out a lot in February. One thing that I think is probably worth mentioning from the political and administration point is that I think it's fair to say that not a lot has happened as far as policy impacting markets. I think there's probably a lot more political policy impacting social things that we're not as clued into. That was one thing I realized that was talking to some friends and just realizing that I'm much more clued into the political market side of policy than the social side of policy. And so there is a lot going on there. But as far as impacts of the markets, not much is actually coming to fruition.
Right.
The big topics, the big themes of the Trump presidencies has been tariffs. We know that he loves a tariff. And another aspect of that is we see so often that they're used as negotiating tools. It's hard to judge a tariff that doesn't ever become a tariff.
Right.
And there's a lot of people trying to figure out, what's going to be the impact of these tariffs? Well, you can't really know until a tariff goes into effect. And as of now, the only one that's got a date to go into effect is the aluminum on March 12th. But that's still 2 weeks away. Who knows what's going to happen in 2 weeks? There's no certainty that everything goes through. It could be another negotiation. There's a lot of that where you're wading through so many headlines, and so many of the headlines are, well, this might happen, but until something happens, there's only so much you can do to judge its effect.
Right. Let's go back to what you were talking about with these key players, the Magnificent Seven.
The Magnificent Seven, which just ran the market for really probably the last 2 years, most notably, if you want to break it into calendar years, has lagged much of the broader market. There's a big slowdown. The Magnificent Seven overall have slowed down a lot. They've lagged the broader S&P 500, which is great. You're seeing that for investors that the diversity in your portfolio is paying off here. To us who are in the world of investing and investing wisely, not chasing performance, it's affirming to see times when 7 stocks don't run the entire market, and you can see value of having this sound theory that doesn't blow up when 7 stocks don't perform well.
Let's talk about consumer sentiment in the market. There's a lot going on with social policy, not a lot of impact happening in the market related to economic policy. The consumer sentiment is overall right now at a confidence in the market rating. Talk to me a little bit about what that means, what's driving that rating confidence.
Consumer sentiment, that's a survey that the University of Michigan does. It's at a 64.7 right now. Historically, since the early 90s, it's not high. It's not the lowest it's been, but it is trending downward over the last month and over the last year. month to month, it's down 10%, year just under 16%. So there is a slowing of this consumer sentiment of the market. I think that pairs with people aren't quite as sure what inflation's going to be doing. That plays into it. The job market's not great. The numbers are staying pretty good with the data, but a lot of those job starts are not necessarily in the private sector as much. It's a lot of, well, they're in the private sector, but it's kind of like linked to government funding. It's healthcare, it's teaching. These type of jobs are still getting good numbers, but a lot of people are talking about kind of this white collar recession. So in like tech, it's harder to get the jobs and keep the jobs. So we're going to see probably over the next year some of the truth come out in those numbers of what's going on in the job market. People are obviously a little bit concerned with the stuff happening with the Department of Government Efficiency, the DOGE group, really going and ripping stuff apart. It's kind of like a rip first, ask questions later, and see if it was something we needed, and then maybe we'll bring it back. But with that, there's the potential for a pretty huge federal employment layoff in the near future. That's already really begun, where I think there's a pretty good number that have taken the severance, kind of like termination offer, like the buyout. So that's going to come into play. If you bring these new jobs into a job market that's kind of hard to fill right now, people are having some trouble in certain sectors getting these jobs. What does it do when you bring an influx of people looking for those jobs? We're going to see what happens in the data, in the economics of it. In the near future, it's going to lag a little bit as that data begins to show up. But that's all type of stuff that's playing into this consumer sentiment of maybe not everything's perfect. It's not going to just keep running and running and running. We need to sort of check ourselves that we're not just going off of hype that everything's great.
Well, it's interesting too how when social policy, that sentiment is impacting the way that people are perceiving or thinking that an administration is running policy, how that impacts their overall confidence in the market and their participation in the economy. You can't really measure that, but I would be curious to see if there are parallels between, the impact of perceived negative social policy implementation and that consumer confidence score. That would be interesting to dig into on another day.
Yeah.
As far as inflation coming out, it's matched expectations with their latest release. So today, February 20, the core personal consumption expenditures, so the PCE index, was released, as well as the consumer price index, the CPI information has been updated. So that all came in matching expectations, and for a lack of a better description, inflation is really stuck in neutral right now. It hasn't really changed much. The needle hasn't moved. What are some expectations for inflation on an outlook perspective?
One of the ways I've heard it described is if you look back at the 9% we were in 2022, the first 6% were so much easier to bring down than the last one. And it's going to take some time to get from that sort of where we're hovering around upper 2s, 3s, down to the 2.5, 2 that people are wanting it to settle at. It takes time. You're right. It's kind of sticky, and we're getting into this space where it's the Fed, in as much that they control the interest rates, is sort of balancing this dual mandate that they have of continuing the economy through job market going, keeping employment solid, while also trying to bring inflation down, in which they're doing a lot through manipulation of the rates. So I would say that the expectations, one of the ways you can kind of look at it is the TIPS bonds, which are the inflation protected bonds or treasuries. Those are sometimes used as a metric to predict inflation, because the idea is you're increasing the payout on a treasury beyond the yield based on inflation. And so that's used as a metric for what's the expectation on inflation. And that has been slightly rising, which just kind of reaffirms what you're saying, that it's sticky, it's not flying down, and there's even the potential that on the way to get down, it may go up a little bit before it comes down the rest of the way. And there's so many unknowns, there's so many variables that can play into it. It's certainly not, all right, it's going to come down that final percent over the next 6 months.
Right.
It's getting pretty stiff.
And that'll impact the next Federal Open Market Committee meeting that happens in mid-March. So March 19, they'll be gathering again to determine federal lending rates. And right now, based on several outlooks, it's anticipated that they'll remain there with the upcoming real estate market really in Michigan, especially launching or getting going at the end of February into March. What does that mean for people considering buying, selling, housing prices? What is the anticipated outlook for that?
Right now, looking into March, the CME does a Fed Watch tool. They've got it at a 94% likelihood that there will be no cut. Realistically, this rate, the federal funds target, it's not going anywhere. It's going to stick right where it's at. And you're right, the interest rates play a big part into the housing market, especially with mortgage right now, because the rates came up so fast from being so low during the rate hike cycle. There's so many people who have these locked in low rates. There's a lot of people that there's no incentive to lose their interest rate to move. So you see a lot more people who are improving, repairing, building onto their house rather than selling and moving. This is playing out. The median age of first-time home buyers has been increasing. The median age of all home buyers is increasing. People are buying less, and especially buying later in life because it's expensive. The housing market is so jammed up right now that not only are interest rates high, but is because there's so many people not willing to sell, and there is a slowly increasing demand of first-time home buyers or people that have grown out of their home and are needing a new home. There is still demand for it, which is going to keep the prices high. Life is expensive. Housing is expensive. Fixing up a house is expensive. These are huge expenses. And so it's not a cheap market. It's not a very kind market to borrowers. And so it's really jammed up. One of the things that's going to have to happen in order for it to really loosen up is these rates are going to have to come down because there's no incentive to sell out of a low interest rate.
Talking about the loan maturity wall, how does that factor into that? Why is that a key metric to watch? And what are some considerations for that for consumers?
It's a big thing in the market, and you'll see it a lot in corporate bonds, corporate borrowing, corporate lending, where there's a maturity where these debt issuances that were at this lower rate are going to mature, and then they'll have to reissue at a much higher rate. It becomes much more expensive for companies to finance their debt, which sort of hurts by nature of the balance sheet and the size of it. It hurts the smaller companies more. So that's something that a lot of people are aware of, that there's a lag effect that could come into play if interest rates remain high. From a consumer perspective, it could show up in how healthy a company's doing. It could show up in prices that a company's charging. There's a lot of ways that it could influence things. All to say, we'll have to wait and see. As with all of these things,
right?
The joy of economics is being able to explain what has happened, and the pain of economics is trying to figure out what's going to happen. But there is this idea that when you have a fixed rate on a low interest rate, eventually that has to come to an end. And if there's a huge jump in what you would then reoffer or reborrow at or lend at the new rate, that's going to shift things in how you're operating day to day.
Yeah, absolutely. So from a client perspective, overall in their portfolio, how are we helping anticipate some of these things that are coming but not here yet? What are some things that our LVZ Investment Committee is doing to anticipate changes or be proactive in this sort of sitting duck period while we wait for the impact of tariffs, for the impact of potential rates staying? What does that look like in our portfolio management?
As we talked about in last month, we made the move earlier in this year, pulling a bit out of some of our small cap allocation, going more to larger, healthy value companies with great balance sheets, good fundamentals that are continuing to grow a dividend, because that is a sign of returning capital to shareholders. It's an accountability for the company to make sure they're not just running through money, especially in times when the economy may slow down, that they're continuing to be good stewards of shareholder investing. That's a big thing we're looking at, is when the momentum slows, when the growth reaches not its peak. Obviously, the market has continued to grow. We're not worried about that over time. But the large growth has had a phenomenal run over the past few years. And the type of run it's had, the over concentration on the largest stocks, it doesn't happen to this extreme very often. And so we're looking for ways to position ourselves for what comes next. And a lot of that is in value. It's in profitable companies. It's in good valuations. It's in dividends. It's in yield, stability that's going to be more durable to the noise of the market. If you've got a really high valuation company, they're very susceptible to news changing the price, which impacts your portfolio. So we're looking for ways to be minimally affected by less than perfect news.
And the beauty of that is it's a team of investment professionals coming together with very diverse perspectives, looking at the data, looking at the analysis, and not making personally influenced decisions. We come to a consensus when we make those decisions to be proactive in our portfolio allocation or making moves that impact clients, anticipating something coming down the road. So when a client gets concerned about what's happening in the market, our team has already thought through likely scenarios and how that will impact their specific portfolio at that time and position them in a place to be proactive instead of responsive. It's the beauty of real-time market management, and that's something unique that our clients have access to here at LVZ with active portfolio management. When clients come together with a portfolio manager that's doing real-time portfolio management in the markets, tell me a little bit about the value that that brings to clients. So when a client calls, how do they best partner with their financial planning professional to execute or best leverage that skill set? Talk to me about some of the risks and the benefits of working with a professional investment management team.
I think one thing that's really important to think about is when you've got a partnership between a client and advisor, think about what each one is bringing to that relationship. I think too often you can think about an advisor as trying to corral and tell their clients what to do. And it's really the client brings the money, the advisor manages it and tries to make the client not mess it up, which is so far from the case. It should be this relationship where a client has this utility that is maximized to them, and nobody can understand the best way to maximize a client's utility more than the client themselves, which is to maximize the satisfaction in their decisions. But nobody makes a bad decision because they think it's a bad decision. But sometimes we make irrational decisions, and that's where if you pair with an advisor who is doing the work, is doing the training, is doing research to understand irrationalities and rationalities in the market, they can help lead your utility in a way that maximizes rationality. So pairing that together, you don't have someone going based purely off, this is what I feel the most satisfaction in this decision. And you don't have someone saying, this is the peak most rational thing, just do what I say, don't feel, don't think. It's coming together to maximize utility and rationality in a way that can benefit the client, make them feel good about the progress, help them feel involved in their own finances, that they're not just handing it off to somebody who's making all these decisions for them. It's a partnership and a relationship that should last for a long time because it's built on trust and partnership.
And that's what I love about the way we approach client service, especially, is that you get to bring your expertise to those clients that we serve. They have access to, they can call their advisor and say, hey, I've got these questions, and you and that advisor sit down together to equip the clients with the information or help them decipher the best moves for them based on their objectives and their goals. So it helps that advisor is acting as a filter to help them decipher how to achieve their goals in the market long term. And truly understanding the client's goal from the onset, I think, is critical and key in what our team does so well in the planning process, but also understands that it's not just about what's in the market, it's about all the other facets in their life that are impacting the decisions and the goals and the objectives of why that end goal is there and what's driving that. And is there any additional factor that may happen or pop up that you can't anticipate that you have to adjust for? And that's the beauty of working with our investment management team and doing that in real time after you have a long-term goal set out. Any key points related to behavioral investing as we move into the month of March, Joey, that you want to emphasize for clients?
I think it's good to remember that a lot of times economists, market people will talk about the broad market and the rationality and the efficiency of it. That doesn't mean that each individual is rational and efficient, and it's okay to not be rational and efficient. And I think that's a good thing to know about yourself as you're coming into a relationship with your finances, with an advisor, to acknowledge that you have irrationalities. So does your advisor, so does every human. and that understanding what those are, understanding your biases, can help you have so much more of a smooth ride with your finances than just kind of going in blind and getting pulled by those biases and not really understanding your relationship with the markets and your understanding of finances and how it causes you to respond. So I think there's a ton of emotional intelligence to learn about yourself, and that can ease the road so much with your financial journey, to just have an understanding of yourself and how the markets impact you.
Mm-hmm. Awesome. Thanks for that. Thanks for your time, Joey. I'm excited to see what happens in the month once things start to actually transpire. As they unfold, you mentioned the upcoming potential aluminum tariff that's unfolding in the first 2 weeks of March. And will there be actual impact? Will there not be? And we'll digest that in the next month. That concludes this month's LVZ Market Minutes. Quick, clear, and curated to keep you informed and empowered. If you found these insights valuable, be certain to tune in each month for a strategic update. Until then, stay informed, stay invested, and have peace of mind that our team is actively monitoring the markets and managing your portfolios.